Good afternoon, everyone. Morning for some, evening for others all over the world. Welcome to today's live trade session for TPO. We have a whole lot to cover today, so we're just going to get right into it. I'm not going to spend a lot of time on announcements. If you're waiting for the trade partner, if you're waiting to be able to invest in trade partner, everything's submitted. We're waiting on final approval, and once that has been given, then we will open up the floodgates. I won't say anything more about that in this call. All right, so the calendar. Last Monday, we were going to talk about profit stacking, but I switched it up thanks to a question by one of the attendees, and ended up looking at crazy calendars for Monday and Wednesday. And so today we're going to be looking at profit stacking at the end of the call. So it'll be like, hopefully, maybe get 20, maybe as much as 30 minutes into that. And we'll dive into that. And I'm going to give you the concept as opposed to, this is the exact strategy that you want to use for it, because it can be used on any strategy. So if you understand the concept, it's really, really powerful. All right, for those that are new on the call, I do want to welcome you. If this is your first call, welcome. However, I also do want to warn you that I don't explain everything about these trades on the call. It's impossible for me to do so. There's just a ton of information that we go over. These calls are meant to be cumulative. They're meant to be attended multiple times, months. As a matter of fact, I would strongly recommend anybody that starts attending these calls attend them for 3 months. I know you can't necessarily attend the live ones every time, but you can watch the recordings as they come out. You will get the hang of it. You will start to understand what we're doing. All the work is on the front end. Once you understand, it's not a lot of work to put these things together and to do really well with them. So, having said that, I also want to warn you that these trades are fantastic, but they are not the holy grail. There are mistakes that can be made. There are market conditions that sometimes become unfavorable. You do not want to be making mistakes, especially on trade size. And if you're going to make a mistake, that's the one you don't want to make a mistake on. If you get the right trade size, which everybody, if you're starting off, it should be one. You place on one lot size, one trade, one spread, whatever. That way, if you do make a mistake, it's a very small mistake. So start small. Make sure that you're not reckless in how you put together these trades. Uh, these things are not designed, I should say, to just hand money over to you, right? So you need to make sure that you're not reckless in how you put them together. You need to make sure you follow instructions. And part of the reason I say you can start small anyway, even if you have a large account, is because it's the compounding that's going to make you the money in the first place. We're not taking these trades to make $500 a week on a single trade. We're not taking these trades to capture this monster move. All we're trying to do is consistently generate a little bit of profit on a weekly basis and then compound it. And you can see here $10 a week on some of the strategies that have the lower risk or lower probability of risk. $10 a week can grow into 35,000 in just 5 years, which is really, really good. $20 a week, if you can increase from $10 a week to $20 a week, you're talking about 135,000 after 5 years. And $20 a week is very, very doable, even in with the most basic application of what we're talking about. And as you improve, look at how much the compounding jumps. So it's like a target that is way off in the distance. If you're off a little bit, uh, with your sight or with your, let's say if you're target shooting and you have a rifle and you've got it zoned in, you move the rifle just a little bit and your target, your aim is going to be way off, right? Well, that's the kind of effect a little bit of an increase in your average weekly gain will have on the compounding in the long run. It's astronomical. So that's what you should be focused on, is learning one of these and learning it well, and then improve as you begin to experience success. And this is the compounding table that you can use. And you can see that within 6 months, or 6 months ish, if you're averaging about $100 a week, you're talking about growing your small account, by as much as $30,000. So you, I can't, I can't sit here and tell you that if you're a beginner, or even if you've been on for a while, that you're necessarily going to get to $100 a week. But if you do, that is what the short-term growth potential is. And then the long-term growth potential for $100 a week is just mind-boggling. So you're looking at possibly $3 million at that point if you can average $100 a week, and that's math. So it's not this pie in the sky dream. It is simple math. You consistently make $100 a week on average, and use the compounding, and you're going to come really close to that figure at the end of 5 years. Okay. All right. So let's talk a little bit about the new option insanity trade, just real quick. I'm not going to spend a lot of time on this. As you well know, I exited the last option insanity trade after all sorts of what I'll call profit stacking um, uh, alterations. I added along, and then I exited the shorts, and then I put the shorts back on, and then I exited the whole thing. I exited one of the extra longs, so I'm not going to go through all of that again. End of day, I was able to squeeze about $1,000 out of that thing. And so I replaced it, and this is what I replaced it with. It's a long 396 call, a single call, and short 5 of the April 5th 404 calls. Total credit was $350. And you'll notice that the short actually expires after the long. That's what creates the option insanity. That's what defines option insanity strategy, is when we're selling the further away option. So this one is not available to everybody, but if you've got a lot of capital that you're not using, this is a great way to use it. And we've been doing this since the option insanity conditions became available again. I want to say back in, what was it, October, November-ish. And we've been consistently putting on this trade, and it's been consistently producing. And you can go in the, you can be, you can have a little bit bigger credit, or you can go way out of the money, have a smaller credit, and just have this astronomical probability of making a little bit of money on the trade. And obviously, with the profit zone, if the market moves up into the profit zone, then you could possibly make even more. So with that, we'll talk a little bit about profit stacking on this trade here in a little bit, but I'm not going to talk about that anymore on this one. I do, by the way, place on, so I trade a small hedge fund, and most of it is, the bulk of it is hyper option, C4 type trades, where we're just selling premium every single day. But I do place this on as well. I place on a few of the other trades. It's not a major piece, but it is a part of it, mainly because it is a little bit more difficult to scale in a fund like that. But nonetheless, if you're interested, this is what the daily result. This is the daily equity. I started keeping this on February 9th, and unfortunately, the brokerage statements don't give me daily equity, the history of the daily equity. But so I'm keeping it manually, and the SPY return since that date is in orange. The fund return is in blue, and you can see we're up about 4%, while SPY is up about 1.5% as of today. So all of this stuff that I'm showing you is being traded in a major fund as well. So just kind of give you an idea. And if you have requested information on the fund, I have not sent it out yet. So that is coming, but I wanted to make sure that the site was completely, how should I say, intuitive as far as the process is concerned. So that may come out tomorrow, may come out Monday. We'll see. So if you requested information, that's what I'll be sending you and when. All right, so this is the worst trade on the board. We'll start with the normal strategies, the non-option insanity strategies, I should say. And this particular trade, if you'll recall, I said I'm going to place on this trade, and I did it during the call, but I said this is ex-dividend week, and you shouldn't place on this trade. And I'm glad I said that because it's been a loss. This was the one on Monday. Of course, the market went immediately up. The market was trading around 386, 387, I think, when we put this on. The market shot up to 395. And you can see this was filled on 3.4. The market shot up to 395, and it's just kind of been hovering around here, and it went up there too fast, and it's ex-dividend week, so the long calls are not going to be worth as much because they're adjusting the prices based on the fact that the price will be adjusted in SPY today after the market closes. And so they also adjust the long value of the calls in anticipation of that. And so you have a little bit different dynamic going on. So there's all sorts of stuff for this particular trade, which is why I said do not take this trade, but I'll do it for example purposes anyway. And so this was where it was on Monday. During Monday's call, we were trading again at about 394, and it was losing about $144 on the time at the time. Look at this. This was right before the call. And this is, again, markets trading at around 394.90 at the time, and it was losing $77. So the time has done us well, but what I want you to notice on this particular trade is that the 395s, they're basically at the money. They expire tomorrow, and the market is going to adjust down today or tomorrow, and these things are still worth $1.05. So there's quite a bit of, there's certainly a possibility that this thing could give me a break even. And that is what I will do. If it gives me a break even, I will exit break even. Because if the market moves down, it doesn't have to move down very much. And I'm going to be locking in a loss on this trade. If the market moves up, then the profit potential goes down dramatically. I'll lock in a loss, and that'll be that. If the market goes down, I stand to make a little bit of money, but there's nothing to say that it'll stay down. Friday can be a volatile day, and this one has just been sitting here waiting. So I'm willing to take the loss if the market moves up, and that's what everybody should be. If you take a trade, you need to be willing to accept the risk of that trade no matter what, so that you don't have to do anything, so that you're not reacting out of fear or whatnot. So here's the question. Since today is ex-dividend day, or tomorrow, and we're trading like right at 395, what do I do? And my 392s are actually in the money, right? So So I'm going to do the unthinkable. Yeah, that's right. I'm going to do the unthinkable. If I can't get out of this trade at a break even today, then I'm going to let these things be assigned. And I know that's a big no-no for a lot of people because they don't understand what's going on with the assignment. So I'm going to explain it to you. And I don't necessarily suggest that you do this because you're going to have margin issues. And if you have any margin issues and you're at a broker where they don't allow you to go into a margin call, and you don't have enough capital to accept assignment, then what they're going to do is they're going to start exiting your short. So they'll assign you, and then they'll exit that assignment, and you will have these longs left. And if the market keeps going down, then you will lose on your longs without having a corresponding short to offset, right? So that's the one thing you have to make sure that you understand what's going to happen if you're assigned before you actually decide to do something like this. That's not going to be a problem with me, so I'm going to let it be assigned. And why would I do that? Well, here's why I would do that, especially if they assign the 395s, right? So if they assign the 395s, that means that I will immediately, and I mean immediately, collect the entirety of the extrinsic value of these calls. However, I will also pay the dividend, right? So they're going to ding me the dividend if I allow this to be assigned. So I have to keep that in mind. But what happens is tomorrow morning, as soon as the market opens, I can resell those 395 calls. I can get out of my short and I can resell the 395 calls. I may bring in 80 cents. I may bring in 70 cents, depending on where the market is at, and then collect more time value. Right. So I'll collect the original time value, and then I'll collect more time value, but then I'll also be paying the dividend. Now, on the flip side of this, if the market tanks, let's say the market drops to 390, okay, and I'm in these 395 shorts that are assigned, and I'm in these 392 shorts, this short that is assigned. Well, guess what? If they didn't assign me the entire value, the entire profit that I could make on the short 392 is 312. But if they assign me and the market drops to 390, guess what? I make $500 if they assign me, if it's at like 395 at the time. All right, I'll make $500 instead of 312. In fact, my profit potential, if the market does drop tomorrow, is unlimited in that scenario. And so given the current circumstances and the situation, I am thinking of, that I'm going to just let it be assigned. And then tomorrow I'll see where it opens and I'll either exit my assignment and resell, or I'll exit my assignment, let's say if it's at a profit, and then be done with the trade. I'll be able to get out at a net profit. Okay. Now, if the market moves up, I have no additional risk from the market moving up, right? My loss potential from the 392 call is unlimited, as would be a short position, right? But I've got my longs. I've got the 397 long here, and I've got my 395 longs here that don't expire until Monday. And so those are still covering me. And so I have no additional risk to the upside if that's what happens. All right. So I wanted to go through that and explain it. And I've just, I just decided to go ahead and, since this was sitting at a loss, I'm going to allow it to be assigned, and I'll see what I can pluck out of it tomorrow. And that way y'all can have okay, here's what happened, here are the numbers, and you can actually experience it kind of through me, if you will, rather than having to do it yourselves and not quite knowing exactly how it all works out. All right, so that's that trade. Let's talk about this trade for a second. This is a risk-free calendar core trade that we placed on. This was filled on 311. We talked about this, and this particular one was filled on 311. The core trade is just a diagonal spread, but I call it a risk-free core trade because our intention is to try and create some risk-free calendars. All right, so with this, I was able to sell a 398, and again, these are expire tomorrow. But I was able to sell a couple of 398 calls and buy the Monday 403 calls. So it's a 5-point spread at 97-cent credit a piece, which means my risk on this trade total is 400 each at this point, right? So if the market were to absolutely skyrocket after I place this trade, I'd be on the hook for about $800. You don't have to do that. You can actually start with a single diagonal spread if you want, and you can shorten the strike difference there to 4 points instead of 5 points if you want. So there's all sorts of things you can do if you're not willing to take that. But I know the probability of this trade of me actually taking the entire $800 loss that's potential was like just super small, almost not even worth mentioning type small. But nonetheless, you still don't ever want to put on a trade that even however small the risk is, you still don't want to put on a trade that you're not willing to take that risk. And that one principle alone will help you make better decisions in your trades. Nonetheless, so 194 credit, that means if the market tanked and I did nothing else, I would make $194 on the trade. Of course, this the trade is a bearish neutral to slightly bullish trade. So the market has some room to go up, right? Market has some room to go up because my short strike doesn't is not until 398. And so that trade alone, has a pretty high probability of being able to pluck something out of it. But the whole purpose of this was to start the process of creating some risk-free calendars. And so this is an added where I add one long 401 call at 80 cents. And I showed you the smart order file where I had that working. That was not filled until like the next day, but it was filled the next day. And so that's what created this risk graph is my core trade plus my extra long, the 401 long call. And so immediately after I placed the 401 call, I placed a sell order to sell the 319 401 call at 80. And that was filled. And this is what was created after that. And then I added another long at, I think it was 76. And then I wasn't able to add another short. Okay, so this is the graph that I had going into this morning because I was in this diagonal spread, which is the core trade. And then I had added 2 401 calls at 78 cents average a piece and one short 401 call at 76 cents actually. So it was one risk-free calendar and plus an extra long is basically what I did. And my intention was to create 2 risk-free calendars by selling that extra 401 call extra 401 call. So that I would have 2 401 longs and 2 401 shorts, and that would create my 2 risk-free calendars. Again, that short never got filled. And so I go into this trade, and this is where we're at $152 profit on the core trade alone. I already know I have no risk on my 401 risk-free calendar call, but I do have risk on the extra long call, which is basically at 78 cents. So I've got a $152 profit here. on my diagonal and a risk basically of $78 on my extra long. So I've got a net profit at this point, no matter what. In fact, uh, the the entire trade could have been exited right here at $1.52, right? $152 gain on this trade. Okay, however, there's something that you can do, and we've talked about, and this trade ends tomorrow. So, you want to either get out, but it's out of the money, so I have really no risk of being assigned unless the market skyrockets between now and the close. If it goes above 398, then all of a sudden this becomes at risk of being assigned. But at this point, this is really a no-brainer. What do you do when you're coming to this trade? I don't care if it is ex-dividend day. This is a no-brainer what you do here. So let's go through this process, and I've talked about this before. But when you're creating risk-free calendars, once you have a profit in the core trade, you can exit that core trade and you can be left with your risk-free calendars, right? And now you've got no risk on the trade whatsoever. And you can do that. And in this case, though, I didn't complete the second risk-free calendar. So I actually have $78 of risk there. So I need to make sure that I take at least a $78 profit on the core trade, either by exiting half of the core trade in this example or by exiting both of the core trades. So whatever I'm at risk on the extra long, that's what profit I have to take out of the core trade before I can exit. Otherwise, I'm not going to exit. If I don't have a $78 profit, and that means either a 40-cent profit on both or a $78 profit on both, and I just exit one. Either or, and I can achieve my goal there. All right. On this one, I walk in and I walk into the trade this morning, and this is where we're at. And so here is exiting half the core trade at where it was at. And you can see here that if I exit half the core trade, which is one, right? I'm exiting 1,398 call and 1,403 long call. So I'm exiting one of those, and that means that I keep one on. But this is the trade that I have now. If I choose to exit half my core, I still make about $100 if the market tanks. I could make maybe as much as $200 if the market moves up, but probably not a high probability of that happening. And then I do have a dead zone, but again, this trade ends tomorrow no matter what, right? So for me to go into this dead zone, it really has to go up pretty high to the 403 area. Not a likely event, and I've only got one extra long at that point, and so it's probably really safe that even on a dead zone scenario, I'm going to be fine. However, if you exit both or the whole core trade, the entire core trade at the $152 gain, this is what's left on the trade. And this is exactly what I did. There wasn't a lot left to be gained on the core trade this morning. You can see it's at 21. I got in at 97 cents, 21 cents. So basically $40 of downside potential on the entire core trade itself. But then, you have the extra $78 on here. So I decided to go ahead and get out, and this is what I'm left with. And guess what? On this particular trade, I'm left with this. And yes, you can think this way, and you can do it this way. It's not for if you absolutely are just now starting, but it is something that you can consider as you become more comfortable with these strategies. And so this is the trade that I have for tomorrow. If the market happens to open up, let's say at around 400 or whatnot, I've got I'll have a pretty decent profit at that point. And guess what that would do? That would almost offset my entire loss on this particular trade, if that were to happen. So basically tomorrow I have a really, really high probability of being able to pull out between these two trades, pull out a total net profit and average, whatever it is, the net will be tomorrow. All right. But even if I didn't have that trade, you don't want this going on, going into the last day. You are better off either switching to this, and my preference is that, especially given the fact that the longs will take a beating tomorrow. The Monday longs will take a beating tomorrow. They will drop volatility, especially if the market moves up. And the less you have to worry about that, the better off you are. And so this is the scenario I would prefer. Again, if the market tanks, I'm going to make about $70 out of this trade, and then I'll definitely make some money out of the other trade that I'm currently losing about $70 on right now as well. Okay. All right, moving on. We're going to get to this real quick so we can get to the profit stacking. This is what we started looking at on Monday. Was the Wednesday crazy calendar trades. This one basically closed 4.5 points in the money and was trading at $1.28. This was a little bit interesting. This is a little interesting week in that we had the Fed meeting on Wednesday, and that was probably holding up the value of the longs. However, they didn't hold up that well. I think they closed at the money Wednesday longs closed at 180. Okay. So we began looking at these trades, and you can see here, this is the 392, 396s, and the market closing at around 396.50. This particular trade ended up having a $282 debit. And so if you entered on any kind of credit, which we entered a trade at 16 cents credit, but this one produced a significant gain on Monday with the market trading right above the 396 average. So there is, some pretty decent profit potential on these trades. Here's the 396 400s. So this was out of the money by 4, and it was trading at 170. And then this is on 311 right before. I'm going to skip that. Actually, I'm going to skip all of these and get to the trade that we actually took. All right, this is it. I didn't want to go over all of the Monday, Wednesday examples that we were looking at because we're fixing to look at them anyway. Nonetheless, this is the trade that I put on, and you'll recall I had to put on a 1, 2, 3 trade instead of a 1, 3, 4 because they don't allow that 4 lot in the spread, so I had to add the extra calendar. And of course, this is the diagonal, 396 short, long 400, and then 3 calendars at the 400. That's what this is. So don't be confused by the 1, 3, 4. This is a diagonal plus 3 calendars, or 2 calendars, excuse me. And then I added the third calendar separately. Okay, and so you can see here where I was filled on 315. This is the 1, 2, 3 trade. 322, 322 were the shorts, and then the long 324. So this ends on Monday. And I entered at a credit of 42 cents, and then I added the third calendar separately, and added that at 26 cents. And so between the two trades, right now making $12 on the separate calendar and $66 on the core trade. itself. So you can see how that was entered. Now, this is the graph, and I think this is fairly accurate on the graph. And we are not yet to the, well, we dropped back down. We were around the 396 area, but we're a long way away from the 400. And so I'm really not too concerned about this, but when you grab these trades and you're looking at a total $78 profit here, and it's Thursday, and we've got tomorrow, and we know the market's going to adjust for price tomorrow, for the dividend tomorrow. My total credit on this trade is only 16 cents total, which is exactly what we were looking at on Monday, is this 16-cent credit. And this is the graph based on the 16-cent credit. Right, so between both of those trades, I had a 16-cent credit, and there's really not a lot of money to be made if the market moves down. And so there's nothing wrong with taking this trade, taking the profit right now, 3-day profit of $78, and you're fine. Ignore the middle trade. That's obviously not having anything to do with this. Nonetheless, there's nothing wrong with doing that, because if the market moves down, all I'm going to make is $16 if it really tanks. If the market moves up, however, there is some additional profit potential. It's a little bit better than 1-to-1. It's not a whole lot better than 1-to-1, but it is a little bit better than 1-to-1. So we're trading at like 395 right before the call. And so this very well may increase a little bit more if the market moves up. If the market moves down a little bit, I actually think I'll still be able to pull out around a $75 to $100 profit. But if it really starts moving down, then that's where that profit starts to go away, and it comes down to only a $16 profit potential to the downside. So if you're trying to average 75, 50, $75 a week, this is a great trade. There's nothing wrong with taking the profit on this, because the probability from where it's at right now is not hugely in your favor that you're going to increase the profit potential by a whole lot on a net basis. Meaning, if I take this trade 100 times, and this is where I'm at 100 times, I'll by staying in, I'll end up a little bit better than on each of the trades in this scenario than if I were to go ahead and exit my profit with my profit. Okay, so it's just the overall probabilities, and you have to do this on these trades and trading in general. What are the probabilities based on where I'm at right now? Because if I were to put this trade on right now, I'd have to put it on at a debit of $78. And would I do that? Absolutely not. And so if there's no way that I would put it on at $78, then you have to start asking yourself, okay, why should I hold it? Why should I keep it on when it's at $78? And you have to work through that. So I wouldn't fret about taking this this particular trade and just exiting it and moving on. Okay. All right. Let's move on to the profit stacking. And what I want to do is I don't want to introduce a brand new strategy or core trade where you can start profit stacking. Even though there are better core trades to use the profit stacking approach on, it's really important that you understand the process, and that the process can be applied to basically anything that you're trading. And so I want to spend a few minutes on this based on the Monday, Wednesday calendar. Since we've been talking about that the last two calls, I want to stick with that with regard to the profit stacking. All right, so let's say you're in a situation where you want to profit stack, and this is so I'm going to give you the best way to do it, the best process, the concept and the principles behind doing it. The best way to do it is to have a core trade where you have a credit. Okay, there are so on this trade right here, right, I have a credit of 16 cents, but that's really not a very big credit. These are harder to use the profit stacking method on. And so you're better off with a little bit bigger credit. And so in this example, what I'm going to do is I'm going to back down just a little bit from the calendars, and I'm only going to have 2 calendars. So I'm going to put on the 1, 2, 3 trade, and I'm not going to add another calendar, is basically how that's going to work. Okay. And so I'm using the exact same trade that I was filled on Monday, and we're going to use that as the example. So this is 1, 2, 3 trade filled at a 45-cent credit, or 42-cent credit. And this is the projection based on just having 2 calendars, not 3. And you can see there's kind of a sag here, and then there's a profit peak at 400. And that profit peak is around $200. And that's probably going to be pretty close. That is based on this long being worth 180. If the market moves up to 400 and we on Monday, and the Wednesday longs should be worth about 180. Now, it's hard to tell whether that's going to be 180, 190, or 170, or maybe even 160, right? So there is a little bit of room here for this to move down. Instead of 200, it might be 120, for example. If these longs are only worth 160, you're going to drop $60 off this profit target. Now, that is a very low number for a Wednesday expiration option on the close Friday. So I'm not too concerned about that. Again, we don't have quite the dynamics going on with regard to the volatility crush. And so I do think this is going to be pretty accurate. But this is not the purpose of the trade. Okay, the purpose of the trade is to profit stack, or to start the profit stacking process, if you will. Okay, so what is a profit stacking process? Well, the profit stacking process is simply where you do something on this trade at some point to put yourself in a position to add to it. Okay, that's the idea, is you want to add to the trade without adding to the risk. And that's the key. That's what profit stacking is about. Add to the profit potential of the trade without adding to the risk of the trade. Okay. If you're writing this down in your notebook, that's what you should be doing. That's what the purpose is. And it's easy to get bogged down in all of the details and get into the weeds of the process, because it's literally unlimited what you can do with this. But you need to keep that principle in mind. That will drive the decision-making process. Okay. So I'm going to bring this over. And by the way, they continue to work on this data issue with PDS Trader. You can't get around the fact that some of the data is not there just simply by throwing some options in there and then changing the date and the strikes, which is what I had to do here. So I apologize that they have not been able to correct that yet. It is coming. Plus, we're about to release a brand new PDS Trader, completely rebuilt, and this one will eventually go by the wayside. Nonetheless, this is, I should not have shown you that just yet. So let me go back up here. So this obviously is the option sanity trade that I'm in. This is the other trade that I exited my core trade. And here is the trade that we're going to look at as far as profit stacking. So what's the first thing that I need to do in order to stack profits? Well, in order for me to stack profits, I have to get rid of some of the risk. That's the first thing I got to do. And that's the best way to do it. This is the best way to do it. There are other ways to do it where you start off with smaller risk and then you kind of add to that risk, but when you add to the risk, you're actually adding more to the profit. I'm not going to get into that today. We're going to stick with this one. What's the first thing you do? Well, this is from a credit of 45 cents, right? It's a 1, 2, 3 trade, credit 45 cents. The one thing that I do not want to do is turn this into a debit. All right, so no matter what I do, I don't want to turn this into a debit. And when you follow that rule, it makes it really simple. What is possible with this trade? There are only two things that are possible that you can do with this trade. And that's it to start the profit stacking process. And that is, you can either get rid of the 396 call or you can get rid of one of the 400 calls. Okay, that's how you would start that. And since you don't want to create a debit, then you are limited at what you can do with regard to the price at which you get out of one of these calls. So if you have a credit, the easiest way to know what you're doing or to begin the profit stacking process and to have the highest probability of being able to start that process is to exit one of the cheaper calls at whatever the credit is. And so I am short 2 400 calls here from 76 cents, right? I'm going to exit one, and I'm going to exit one at 45 cents on a target. So this will be as soon as I get into the trade, and this is why trade partner is so important. Because as soon as you get into this trade, as soon as you're filled, you can already have this exit order working, and you don't have to sit there and watch it. And so you have this exit order working, and why 45 cents? Because that's what your credit was. And if you exit it for anything more than 45 cents, that's going to create a debit to the downside. So if you exit it at 50 cents instead of 45 cents, you actually have a 5-cent debit to the downside. Plus, you'll see these dead zones sag a little bit more. All right. So this is the trade that is created instantly when you exit one of the shorts at 45 cents. So you're only taking about a 30-cent profit on this thing. That's it. And you're able to start the process for profit stacking. So a lot of people do this and they just keep this, right? Or they change it up. But the simple profit stacking approach is if the market moves back up, you add that 400 short back in at 76 cents. That's the simple way. And then you exit. And we'll go with, then you exit that one at 45 cents again. And when you do that, let me update that. So when you do that, you now have an overall credit on the trade, and you move this whole thing to the upside, right? You keep moving this to the upside. And you can do that again, right? As many times, much like the risk-free calendar spreads, that's how you stack them, right? So you can try and continue with that whole process until the market doesn't allow you to do it. Let's refresh that. Okay, so now if I've done it 3 times, my minimum credit to the downside is $63. So I'm guaranteed to make $63. I now have maybe as much as 200. I really wouldn't count on 200 because it has to be right at certain strikes in order to do that. But high probability of being able to pull out $100 to $150, really high probability of being able to pull out $100 to $150 on this trade at this point. Okay. But let's say you only are able to do it once. Whoops, let let's say you're only able to do this once. Whoops. Here, there we go. All right. Now I'm going to do it once after I reset this. So I do it once, exit at 45, not 30. And then I end up reselling it. Okay. Once I resell it, obviously I add back in the risk, but the risk is less, right? Because I took a profit and then I resold it at a higher price. So technically the risk is less. Obviously, because I put this core trade on when it was out of the money in the first place, I have a really high probability of success anyway. But that is, that's the process. Obviously, if you do this, then whether you're able to exit that additional one or not, you have improved the trade immediately by a little bit. So even if you only do one, you're enhancing by $30 a week. And you remember what a $10 change in your average weekly profit will do when you start compounding that. So don't discount the fact that if you're only able to do it once, that it's not that big of a deal. It is a big deal when you're talking about doing it over and over and over and over again, week after week after week after week. If that's all you do is just one enhancement, you have improved your overall profit potential on an average basis. So this is it's a wonderful process. It can all be planned out on Trade Partner, so you don't have to sit there and worry about it. And if you're concerned about the day trading rule, so you're only allowed 3-day trades in a 5-day period, right? So if you get to the point where you actually do this 3 times in a single day, or you have a 1-day trade today and then a day trade tomorrow and then a day trade the next day, right? If you get to that point, you can stop and you can go to another strike. I'm not going to get into the weeds with that. I just want you to think about that for a minute, for a little bit, and we'll cover that in more detail at some point in the future. But I could start selling the 401 once I get to a point where I've had 3-day trades with this trade now. Instead of adding another 400, I could add I could do the 401, or I could do a 399 and start that process and create a scenario where I don't have to worry about breaking the day trading rule. So there are all sorts of ways to get around that with this type of trading. But the great thing is that Trade Partner allows you to do this automatically. What I do is I set it up a couple of iterations during the day, and then I'll look at it the following day, and I'll set up another smart order file based on where the market's at. I may change the strikes at that point, but I can do the whole thing. So, for example, it may be that that I was able to exit, but let's say I was able to exit that second one, but I wasn't able to resell it a 4th time, and the market closes. Next day, the market opens up 3 points, 4 points, and all of a sudden, this thing's going for $1.50 or something like that. Well, I don't have to resell the 400. I can sell a 402. Let's say I sell a 402 for 75 cents. All of a sudden, I've just increased my profit potential, and I've basically reset my risk. Do you want me to do that? Sure, I'll do that. So that's 3. So I'm going to say 402. We'll add that to risk-free. So let's say so I'm going to change the date here. and we'll go to 1. So let's say I get into a scenario and I'm able to exit my second short, and I need to resell this 400 again. Only the market opens up the next day, and I'm able to sell a 402 for 76 cents. All right. Watch what happens to this graph. As opposed to having $200 risk or about that to the upside, now that's the graph I've created. All right, so that's why I don't do it endlessly. I look at the market in the morning, and if the opportunity is to go further out and completely get rid of the risk, I will do that. And that's what you can do by going further out of the money. All right. Now, this process can be applied to any trade, right? I have a 350 credit here. This is option Sandy. I have a 350 credit. Basically, I can exit any one of my shorts, or 2 shorts, or 3 shorts, or 4 shorts, or 5 shorts, as long as I do so for a total cumulative profit of $350. I then create a risk-free trade on this scenario. So, for example, well, that's not true. I don't create a risk-free trade. I create the possibility to profit stack. If I get rid of all 5, or if I get rid of 4 at a total profit of $350, I've created a risk-free trade. All right, so I'm going to get rid. Let's just say I get rid of 1, and I get rid of 1 at 50. So that's the new trade, right? And I can either keep it that way. I still have a pretty decent credit. I can either keep it that way. My break even is way up there, or I can add that back in if the market moves up at the original price, and just keep going, right? So I increase my overall credit. It's now at 486, and I push that break-even point even further to the upside. That's what profit stacking is, right? If I were to do this on 2 of them, and then only add 1 back in. Now I could do that and look at that trade, right? Or if I were to add 2 back in, then I have a monster credit here. Let's see here. There we go. So now it's well above 500, right? So there is nothing that you can't do this in, as long as you understand where the limitations are and what you can and cannot do in order to maintain the integrity of the trade. All right. All right, let's see if we've got any questions. And I know this is, if you're new on the trade, I know you'll probably never seen stuff like this. And if you're completely lost, just keep coming back. You will understand it, I promise you. All right, let's see here. As a new member, where on the PDS Trader site is the best place to review the basic structure of the trades that you discuss in the live webinars? Go to portfolios. Go to portfolios and create a portfolio, and just understand that we're having some slight issues with the SPY data, and you have to just put in a couple of legs into a portfolio and then change the data to whatever it is that you're looking to change it to. Let's see. I tried placing a long calendar spread on ATM. It got rejected by the broker, stating no initial margin. I have a margin account. Krishnan, So if you try placing on a long calendar spread, there, I mean, yeah, you should not, it should not have been rejected. I would definitely call your broker and see if there's something that you did wrong. Having a bullish outlook, if I finance my calendars using a spread and place a lot of calendars at the same strike, is there any risk that I will be facing? Yes, Christian. So the more longs you have, if the volatility comes out of those longs, the more room for error you have. So, for example, let's say the projection is on a calendar spread. If the market is at the money at the time that you close the calendar spread, let's say the projection is at $140. Okay, but then the actual trade, when the market does get there, because the volatility is coming out of the longs, let's say the value is only 120 instead of 140. Well, that's fine, you know, if you only have one. If you have two, that's fine. If you have three, that's fine. If you have 10, that's a $200 difference. And so you just have to make sure that you are accounting for a volatility drop in that. And by the way, you're not going to get the maximum gain on those for the most part. So early exits is also a very, very, very effective way to reduce that margin for error. Is there any way to actually see what you do tomorrow on the crazy calendar? I'm in it and would like to follow your example. Thanks. Rick, you're in the one that I said don't get into. I mean, I'm going to record exactly what I do, and so I'll discuss that in Monday's call. Dan, the seminar was where did you get information on the live seminar? Because that was last year, and I'm not doing it. At least it's not planned for this year. I may do another one, but we haven't planned for another one yet. In the put side, there isn't any financing opportunity with ATM. OTM is available on the call side. It doesn't matter whether you have put calendars or call calendars. They're the same thing. They're the exact same thing. So you can absolutely finance put calendars with a call diagonal spread, because the call calendar and put calendar same. If you have a 395 call calendar spread, it's the exact same thing as a 395 put calendar spread, as long as it's at the same price. Let's see. Can you please give us a crazy calendar trade to take today? Mark, so I meant to go through this, and so I apologize. I didn't get to going through this. So this is a 1-2-3 trade. It was trading at 40 cents earlier, 329, 331. So this would be a Monday, Wednesday. This one was trading at 40 cents earlier, like right before the market, right before this call. This is one I would have considered placing on, but since I'm already in one, and let's see, where is the one that I'm in? So here's the one I'm in, right? 322, 322, 324. This is 134. It's at 62 cents. So I'm actually in this one, and and it doesn't end till Monday. So I'll replace it on Monday. If you want a regular crazy calendar with Friday, let's say Friday, Monday, let's take a look and see what's available, shall we? Let me see here. I'm going to reset the spreads on that one, and I'm going to go I'm going to go 5 points out, and I'll bring this down here in a second. Whoops. So it's going to take me just a second to set this up. Actually, I'm going to start from, I'm going to start a new pattern. So y'all can see how the spread patterns works. What in the world is going on? My computer's kind of freaking out on me here. All right, so let's go new spread pattern. And I'm going to go. So here's one issue. We have Good Friday, which is April 2nd. So that means it's a Thursday, Monday expiration, which there's nothing wrong with that. But it does add, it makes it harder to get fill price. So I'm going to go 392, 397 will be my diagonal, and then I'm going to go 390. I'm going to do 396s, and let's just see what's available, if anything, on these. All right, so that one is $1.29, but that one's not out of the money, right? And we definitely want to do these that are out of the money, and I think it might be a little hard to get a credit on these. So I'm going to start with 393, and then I'm going to go 413 and 1, and generate the spreads. So let's see if it will populate. Oh, so we've got some issues with strikes on some of these. And of course, there we go. So let's just see how far we can go. So here's 398, 403 with the 402s. That's not bad. 22 cents, but it's only 3 calendars. 4-1, by the way, is a bullish day. First calendar day of the month. It's right before Easter holiday, which is also bullish. So I will mention that. So looking like 27 cents with that. And where are we trading? We're trading at 395-ish, right? So you can get a credit all the way out to, let's go 400s and the 404s, and you'll have a credit of 12. The value of these will be a little bit better because it's actually 3 full days, even though none of them is market trading day. But other than that, I would absolutely consider this one. Just understand that the 3 calendars is not going to give you like a huge boost at 404. So if they do take the market up there, it's not going to be, this massive profit potential. Okay. Yeah, I'll keep that up there. So there we go. Let's see here. Please show the slide before the exit entire core trade at 152 slide. Slide before. Let's see. So that's to exit half the core trade. Is that what you're looking for, Dan? So demanding. Let's see, financing calendar is easier in SPY or SPX. SPX, you're going to be charged full margin. So you have that to consider. Can you paper trade using TP? And unfortunately not. We don't have that set up yet. It is in the plans down the road, but it's not there yet. When you say do this as long as the market will let you, what does that mean? Michael, that means that, so for example, in this trade, let's get rid of this. So in this particular trade, let's say I was able to exit 2 of my shorts and replace those 2 shorts, or replaced it once. And then the market moved up. Well, I can't exit that anymore, right? So the market dictated, let's say my 76 short call never got back down to 45 cents. So the market dictated I couldn't do that anymore. Or I may exit and then the market tanks and I can't resell another one for 76 cents, right? Because it never gets up back up to that price again. So therefore, the market did not allow me to complete that process another time. Followed it completely. Great concepts and info. Thank you, Terry. You really can't do this without access to Trade Partner. You get the same visuals from a platform other than this one, correct? Frank, you can do it. You just have to kind of watch the market because you can't. Other platforms don't allow you to place contingency orders, especially when you're dealing with spreads. Is there a trade possible for next week? The 1, 2, 3 you just showed is trading at a 10-cent debit. So since I'm in basically 4 different trades and they all end either tomorrow or Monday, I'm not going to take another trade today. So what I'll do is I will place another trade on Monday to replace the crazy calendar that we did, as well as another risk-free core process. Let's see. I see. So, gotcha. All right, Dan. Do you also meet on Mondays? Yes, we do. We meet every Monday and Thursday, same time, 2 o'clock Eastern. So Monday and Thursday, you get all that you can possibly want. Okay, maybe not all that you could possibly want, but you get a lot. Now that SPY is almost at all-time highs, could I use crazy calendars with the short and the margin hedge and wait for the next crash? It is the highest probability, right? I'd be very careful about that. I wouldn't. So personally, when the market's moving up like this, I do favor the trades and position them to have bigger credits. And I'm not quite as bullish in how I put the trades together. But that doesn't mean I change what I do. I never completely change what I'm doing because I think the market's going to go one direction or the other. I may slant a trade slightly more in favor of that, but I don't change entirely what I'm doing. Would I recommend I watch any videos you may have independently on my own? I did a lot of double calendars. And sometimes by adding a call or short, I would raise the wings that were going down. I think you're doing something similar on steroids. Yeah, so you actually have access to those videos, Dan. So if you don't know where to find them, contact support and they'll point you in the right direction. Sorry, I didn't frame my previous question properly. On the put side, there isn't any credit spread opportunity like it is in the call side. That's correct. It's only available in ITM for a put side. Is there any risk of signing or the risk that is created in ITM? The put side, no, to answer your question on the assignment. But the put side is going to be elevated as far as the diagonal spreads are concerned because of the extra risk of the market moving down. So like they price the out of the money calls for a drop in volatility, they price the out of money puts for an increase in volatility. Okay, that's how it works. And so that's why you can't get the same trades. Let's see here. Came late procedure for share purchase trade partner. Oh, G2 and A2. So we have submitted everything and we're just simply waiting for their approval. So we have not yet made that available. So we're just waiting on them at this point. Thanks for confirming. Mondays do the same link on Mondays. Honestly, Dan, I don't know how they have worked the links, but I think so. But if not, contact support. And yes, the recordings of every one of these webinars is available to you. So you can go back and watch as many as you want until your heart's content. All righty. Looks like I got all the questions. And I hope you enjoyed the call today. And I will see you again on Monday. Everyone have a great day and a weekend.